Indicators are mathematical constructions that use and process past price data which is detected in specific assets, with the aim of predicting the future trend of the price movement. Indicators are numerous and complete the framework of technical analysis. Indicators are mainly used to analyze the volatility, the volume, the momentum, and the trend of a specific asset. You should never enter a trade based solely on an indicator. Indicators have to be used as a final confluence of technical and fundamental analysis. There are two types of indicators: the leading indicators and the lagging indicators. Leading indicators are used to predict future price trends through the statistical study of previous prices. Lagging indicators, on the other hand, are used to predict the future trend of prices through the signals given by the current market trend and price action. Some of the most known examples of leading indicators are the relative strength index and the stochastic oscillator. Some of the most known examples of lagging indicators are the moving averages, the moving average convergence divergence, and the parabolic SAR. The stochastic oscillator is one of the most useful indicators when trading. The stochastic allows you to evaluate price fluctuations and provides indications on the strength of the trend, as well as the momentum of the price, indicating entry and exit signals. The momentum is the rate of acceleration of an asset's price. The stochastic is called oscillator because it oscillates between the levels of 0 and 100. No matter how much the price on the chart moves up or down, it will always fluctuate between the levels of 0 and 100. This indicator examines how close the candle closures are to the resistance or support, recorded over a specific period of time. The fundamental use of the stochastic is to identify areas of excess and to understand when the price is oversold or overbought. The overbought zone is identified when the stochastic fluctuates above the 80 level. Overbought zones give us signals to sell. The oversold zone is identified when the stochastic fluctuates below the 20 level. Oversold zones give us signals to buy. When the oscillator indicates oversold and overbought areas, you shouldn't buy or sell immediately, you always need confirmation from price action. The stochastic, when indicating the level 80 or level 20, is telling us that the trend right now is strong, and we need to be patient and have a slowdown of momentum before price can reverse. If you see a rocket going up into the sky, it will have to slow down before it starts its downside momentum, and the same applies for the price. Momentum always changes direction before price. The default stochastic period is 14 periods. This means that using the one-day time frame, 14 periods are equivalent to 14 candles of a day, therefore 14 days. On the other hand, using the 1 hour time frame, 14 periods are equivalent to 14 candles of 1 hour, therefore 14 hours. The stochastic oscillator is formed by two lines. The red line is called the percentage K, also known as the fast line, and is more sensitive to price changes. The blue line is called percentage D, also known as the slow line, and is the one that allows you to generate buy or sell signals. Once the indicator arrives in the overbought or oversold area, you have to wait for the red line to cross the blue line in the direction of the new trend, giving us further confirmation. This intersection must be combined with price action analysis, having candlestick closures that confirm the new direction. Another very effective method to use the stochastic is by analyzing the divergence between the price and the oscillator. A divergence is simply a price movement that is not confirmed by the stochastic, indicating a potential reversal. A bullish divergence occurs when the price shows a lower low, but the stochastic showing a higher low. A bearish divergence occurs when the price shows a higher high, but the stochastic shows a lower high. These divergence signals indicate the end of a trend, and a potential trend reversal. Divergence analysis helps to avoid liquidity traps, and above all helps to understand the best time to enter the market. Technical analysis uses the relative strength index as a momentum indicator. To assess whether a security's price is overvalued or undervalued, the RSI evaluates the speed and amplitude of recent price fluctuations. The RSI is represented as an oscillator that ranges from 0 to 100. The RSI is frequently placed beneath the price graph of an asset, to give technical traders clues regarding bullish and bearish price momentum. When the RSI is over 70, an asset is typically seen as being overbought, and it gives a potential signal to sell. When the RSI is below 30, an asset is typically seen as oversold, and it gives a potential signal to buy. The RSI can remain in the overbought or oversold range for a long time, especially when the stock is in a strong trend, as shown in the chart above. To effectively use the RSI, it is crucial to understand the security's main trend. The RSI oversold level is most likely higher than 30 during an uptrend, and lower than 70 in a downtrend. Retracements in a trending market typically stop at the level 50, before continuing with the main direction. The following chart illustrates how the RSI peaks near 50, rather than 70 during a decline. In contrast to trading ranges, the relative strength indicator is less trustworthy in trending markets. In actuality, the majority of traders are aware that the RSI's signals, during significant upward or downward movements, frequently tend to be erroneous. The RSI can provide false alarms in trending markets, therefore traders may benefit from using bullish indications, primarily when the price is in a bullish trend, and bearish signals, primarily when a stock is in a bearish trend. When price shifts in the opposite direction of the RSI, this is known as an RSI divergence. In other words, a chart may show a change in momentum prior to an associated change in price. When the RSI shows an oversold level, followed by a higher low, but the price shows lower lows, this is known as a bullish divergence. When the RSI shows an overbought level, followed by a lower high, but the price shows higher highs, this is known as a bearish divergence. RSI signals, like those of any other technical indicator, are more reliable when they follow the long-term trend, and are backed up by other major confluences.